Welcome to Option Trading for Beginners, the 2026 version. I will be your host for today. My name is Stephen Manning, and I am the founder of CFU. And I will be investing in XAI, but that's not financial advice. Why do options matter in 2026? Well, the daily volume right now is 59 million contracts are traded every day, and one contract is equal to 100 shares. So 59 million contracts every day. The volatility has surged at over 3 times normal volatility from previous years, and 0 day to expiry options are becoming very popular, and a lot of day traders are starting to use them. Case in point, even today, Hood and Nvidia and other players as well adopted Monday, Wednesday, and Friday expiration dates. So the volume, the volatility, and the near-term trade is becoming even more important. If you're interested in learning more about them, head on over to joincfu.com and read about the community that they have. They are a Discord community, they're a trading service, and they also offer educational videos such as this one. Who is this guide for? This is intended for new traders with zero experience when it comes to options. This is also intended for stock option investors who have heard about options and are curious what are they and how they can take advantage of them in their portfolio. This is also intended for income-focused learners who are interested in seeing how options could play a role in their portfolio for generating additional income to pay for monthly bills or expenses. And it is for people who want to avoid the YOLO trading mantra that's kind of out there right now in social media and on other platforms. They're sick and tired of being rugged, and they're sick and tired of learning the hard way that some of these services aren't really as they seem. So let's get into it. Let's learn about options. So, what will you learn in this? You're going to learn about how options actually work, reading an option chain, the Greeks that matter most. You may have heard about Greeks and the important role that they play in option trading. Today, we're going to go over those that matter the most, and I will, as we go through, highlight those that, yeah, you need to pay attention to this Greek, and this other one maybe isn't as important. We're also going to cover off some very safe beginner strategies that are not high risk, they're not involving much leverage, if at all, and they're a great way to cut your teeth on when it comes to option trading. Risk and psychology rules, always very important to have a mind for the markets. Important disclaimer, and we are not sharing financial advice. As we go through some examples, we will mention particular stocks. Some of those stocks are high beta and are high risk. And option trading, by its very nature, being a derivative financial instrument, is inherently risky. And if you trade options, you do stand the risk of losing your entire investment. So please be careful and take this with a grain of salt. This is for educational purposes only and is not to be construed as financial advice. About the instructor, well, my name is Stephen Manning. I've been an option trader since 2008. Times are very different. Today we have a very liquid option market, very actively trading. Now we have stocks with option chains that are being traded 3 times a week. That was not the case when I started. I focus on beginner education and accessible strategies so that other people can begin to trade options and see just how valuable of an instrument they are in your portfolio. I do have a risk-first philosophy. Having been started in 2008, I know what it's like to come out of the backside of a financial crisis and to take advantage of that. That was played out again when COVID hit us. I like to teach what's actually being traded. I don't like to talk about theories, and I don't like to talk about trade recommendations that really don't play out, or by the time you get that trade alert, it's already passed. So I like to talk about fill orders, actual things that are getting completed, and not just theoretical concepts. I do value what we can actually trade and do. I started Cashflow University in September of 2022. We've been around for 3.5 years, and we're about to complete our 4th. How to use this guide. First, learn the concepts that we're going to share with you today. You may need to fast forward to certain sections, re-listen or re-watch certain sections, and you may want to skip ahead if you've already got the foundations in place. Paper trading is always recommended. It's a way for you to get familiar with how to enter an order for a particular option strategy, how to get ready to learn and read the Greeks, and how to get better before you actually start putting real money in. When it does come time to put in some real money, maybe start with the very bare minimum, money that you could afford to lose and not lose sleep overnight. That all being said, if you do start trading options, please start trading just one contract per trade and track your results weekly. We do this and practice this at CFU very religiously. We always track the trades that we share with our members and we track them through to completion. Let's get into it. What is an option? Let me be totally frank with you and be upfront. A contract does not mean ownership. At best, all you own is that contract. What does that contract give you, or what does that stock option give you? It gives you the right to buy or sell stock in the future at a particular price. That means you have calls give you the right to buy, puts give you the right to sell. They have a fixed price and they do have an expiration in the future. That means not all options are going to last forever. For example, you will say in the future, say in the middle of June, I want the right to buy Microsoft at $500. That has an expiration, that has a fixed price, and you're wanting the right to buy Microsoft. And funny enough, time is money. We've all heard that before, but nowhere is it more explicit and carried out in the option market. In the option market, time is money, and you can actually see how much value that money carries as you trade options. Stocks represent ownership in a company. They have no expiration date. You can literally buy and hold that stock forever, assuming that the company does not go out of business. The value of that stock, that share that you own, is based on the fundamentals of the company. How many assets do they have? What are their liabilities? What are their growth prospects looking like for the future? All those come into play, and then the market gets to bid and have an auction each day on what is the value of one share of Tesla, or what is the value of one share of Procter & Gamble. They have little to no leverage built into them. At most, a stock has leverage in terms of how much debt and how much amplification does the underlying company have. Options, on the other hand, do have leverage. Each contract represents 100 shares of a given company. They do have expiration. So you do need to be aware of when does that stock option expire? Does it expire in 2 weeks or does it expire in 6 months? It is possible, and it is actually more than likely, that an option will expire completely worthless. When it does expire completely worthless, it just vanishes from your account, zero transaction fees, it just disappears. It's the weirdest thing, but with the first time when you see it happen, it's kind of fun too. Faster gains and also faster mistakes. It is true, you've seen on social media some of the gains that you can expect to gain from trading options, but just as likely are the mistakes that can cost you just as much money. Let's get into call options. This will be the first type of stock option that we cover today. A call option gives you the right to buy a stock at a particular price. This is the bullish version of an option. It has bullish direction. When that underlying stock goes up in value, your call option will likewise go up in value. So say, for example, we just talked about having the right to buy Microsoft at 500. Of course, that's a call option. And then you have a bullish emphasis or a bullish sentiment on Microsoft. You're thinking that between now and June or between now and the end of the year, Microsoft will exceed $500 per share. You buy that right and you hold on to it. Your risk that you have with this is limited to the premium that you pay. Look at it like this is the price that I paid. I paid $1,000 for that right to buy Microsoft at $500, and that's the most that I could stand to lose. The profit of that call option rises, of course, when the stock rises underneath. Put options, on the other hand, give you the right to sell stock at a particular price. So in our case with Microsoft, if it's trading at 465, you would buy something like, I want to be able to sell Microsoft shares at $450 between now and October, thinking that perhaps between now and October, there could be some bearish news or bearish outcomes that occur. It is a bearish or a hedge position that you're getting into, and the risk that you're limited to, or your downside risk with a put option, is again limited to the premium or the price that you pay up front. You profit if the stock falls. So if Microsoft goes from, say, 465 down to 400, that ability to sell Microsoft at 450 suddenly becomes very lucrative. There are buyers and there are sellers when it comes to options. Option buyers are the ones that pay the premium up front. They're going to pay you the cash in order to have that right to buy or sell Microsoft at a given price. They have the right, but they do not have the obligation. This is a very distinct point that you do not have the obligation to buy or sell that particular stock at that given price. That's very important because you may not want to in the end. Right. Though your brokerage would ask you, look, man, Microsoft is trading at 520 and you do have the right to buy those shares at $500 and you can sell them at the market at 520. Don't you want to do it? Of course, that makes financial sense. And so you would exercise that right to buy Microsoft at 500. This all being said, it's just important to realize you don't have the obligation. You have to fight time decay every day when you are the holder of the option. And this goes for both calls and puts. Every day that you hold on to that option, you are losing money. You do need the price to move to your favor. So if you've got that call option, you want it to go up. If you have the put option, you want the stock to go down. Option sellers, on the other hand, and yes, you can become an option seller. In fact, it's one of the most attractive attributes of options is that you can be both the buyer or the seller in every transaction. Option sellers, you are the ones that receive the money up front. The buyer just paid $1,000 for the right to buy Microsoft at 500. You get that money into your brokerage account that same day. You do hold an obligation to transact with that stock. So say, for example, you sold the call option to buy Microsoft at 500. You better have at least 100 shares to honor that one contract. And you do have the obligation to deliver Microsoft at $500 should the holder of the call option exercise that right. Of course, he will only do that if Microsoft goes above $500. You do face potentially higher risk with this because your margin account, your brokerage account, they will say to you, yes, you've sold that option, but we do need to have some collateral to back up your obligation that you hold. If you're doing a covered call, which is the most popular option strategy around, you will have to have 100 shares for every contract that you have. If you're selling a cash secured put, just like the name implies, you have enough cash to buy the stock at that given price. So there's just potentially higher risk. And that's one of the things the buyer of the option is paying you for. They want to some degree to eliminate risk, and you as a seller are assuming some risk. Is the option price. Every option that you can look at has an option price. It'll have a bid and an ask, and it'll often share what the last price that option traded at. They are multiplied by 100. So when you look at an option, it'll say 2.64 or 3.50. That means that it's actually, when you go to transact with that option, you have to times it by 100 because the quote that you're seeing on your screen is per share. But a contract that you're going to be trading is actually representing 100 shares for every contract. So you have to multiply it by 100. It's very easy when you see like 9.64, 3.54, you just multiply it by 100 mentally in your head. You just say, hey, that's not 355, that's $355. It's affected by multiple factors, and we will get into that today. And your maximum loss as a buyer is the premium that you paid. Contract specifications. So like we've also mentioned a few times already, every contract represents 100 shares per contract. Now, there are two different styles of options that are in the market. There are American and there are European style options. Funny, isn't it? You would say, isn't there enough dynamic and enough definition for options? Let's get into the difference on that. If you're an American trading US stocks on US stock exchanges, by and large, everything you're trading is defined as an American style option. This means that between the time you transact with that option, be it that you're the buyer or the seller, you have that right to buy or sell that stock, but you can do that at any time. You can do, say you did the September call option. I can do it. I can exercise that right anytime between now and September. Same if I have the put, I can exercise that right anytime between now and September. I just call up my brokerage. Oftentimes there's a menu within their app or the website that they have. You just go in and say, I want to exercise that option. Very easy to do. That's where they're very different. European style options, they only get exercised on expiration date. And that's the big difference. If you hold that call option on Microsoft, if it's an American style option, you can exercise it any day of the week, except for the weekends. If it's a European style option, you cannot exercise it until expiration date. The benefit there does favor the seller because he can't be exercised early and he has a bit of, phew, I can just kind of wait and settle this on expiration date. Index options are almost always cash settled. Now, this is an important distinction because you've likely heard about SPY or SPY. That is an ETF that tracks the S&P 500. That is traded with American style options, and they are settled by 100 units or 100 shares of the ETF. That is not the actual index of the S&P 500. That is merely an ETF that tracks the index. With options, you literally can trade the S&P 500 index. That is different than the SPY ETF because those index options are European style, which means they can only be exercised on expiration date. And those index options at SPX, which tracks the S&P 500, is cash settled. So on settlement date, they take a sum of where the index is at, they look at the calls and the puts, and then they start moving money around. So if you're in profit, you get money deposited into your account. And if you're short or you owe money, that money will be withdrawn from your account. Expiration and exercise. So there are expiration dates. We've already talked about this actually with Hood and with NVIDIA that they are actually daily now. They have Monday, Wednesday, and Friday expirations, but there are daily expiries. This is mainly for things like the Qs and SPY where you have daily expiring options. There are also weekly options. This is by far the most popular, and those expire every Friday. So if people are talking about weekly options, those are going to expire on every Friday. There are monthly, and that happens on the third Friday of every month. LEAPs are long-term equity anticipation securities. That's what the LEAP stands for. They're essentially just stock options that are far into the future, 1 to 3 years. Those are mainly expiring on December or January of the year. So if you're talking about the LEAPs out into 2027, that's likely going to be the January 2027. Key points is most traders close their positions before expiration. Now, it's a common fallacy that a lot of covered calls or cash secured puts, they'll go to expiry. Pro traders will often close those out. Once they're down to a nickel or a dime, they'll close them out. It's just not worth holding it through that extra day just to hold it to expiry for a dime or for a nickel, because at that point you're exposed to gamma risk. So say there's a tail risk, man, you waited around for $5 and then now that unforeseen black swan event occurred. So most professional traders choose to close their positions before expiration. Brokers will auto exercise. So if you're just like, I don't want to close this position as you go into expiry to settle off, they will automatically exercise your options for you if they are in the money. So my little rule that I like to have if you're beginning to trade options is avoid holding through expiration date. I think it's a good idea for you to get used to opening, sell to open, and buy to close off that position once you've made some money. That's especially relevant in today's day and age where the fees or the commissions for trading options are extremely low, if not free. Okay, let's just do a quick little summary of where we've come from so far. What does one option contract control? One option contract lets you control 100 shares of the underlying stock. This is the standard contract size for equity options in the US market. What are the two types of options? There are calls and there are puts. Calls give you the right to buy, puts give you the right to sell. What is the maximum loss for an option buyer? It is always going to be the premium that you pay or the price that you paid up front. As the holder of that option, you cannot lose more than the premium that you paid. All right, we also give you a free scanner called the PCS 100. This is a bullish only scanner, so this will go through and it'll scan 30 stocks day in, day out, every minute of the day while the market is open, and it'll find the best put credit spread for you for that particular stock. And we are talking about the 30 most liquid and 30 most popular stocks for trading options. So for example, we have SoFi on there, NVIDIA, Palantir, Apple, you name it, we probably have it. CrowdStrike, CoreWeave, etc. The list goes on. What we don't have are stocks like Johnson & Johnson, Procter and Gamble, and other boring boomer stocks. Why is that? There's just not a lot of volatility in those, and there's often not a lot of liquidity. The third gift we give you as well too within this starter kit is we give you the gift of a community. So you can join our Discord, jump in there, read some of the channels. Yes, your access is limited because the premium channels, we save those for our paying members, but it is a great way to get 1 or 2 free trades every single month and learn from our experienced staff that we have at CFU. If that interests you, head on over to joincfu.com/starter kit. All right, let's do a call example. Let's say we're going to start with a stock trading at $195 per share. What stock can you think of that's trading at $195 per share? The one that first comes to mind for me is NVIDIA, and that's a popular stock, and I like to go with that one. I love that stock. And again, this is not financial advice. I'm just sharing here that I personally love it, and I do personally hold it. So just full disclaimer there, anything I do say about NVIDIA will likely have a bit of a positive bias at that. But they are trading at about 187, 188 right now. And so let's just assume they're trading at 195. So when we enter into our call example here, we're going to use the 200 call option. It's a little bit out of the money, but that's the one we're going to buy. It's a bit of a speculative bet. And the most we could get on this is an unlimited upside, but we do have to pay $3 per share up front. Because one contract represents 300 shares, that means that this call option is going to cost us $300. Remember, the quote of the price is going to say 3.00. We multiply it by 100, and that gives us $300. Our break-even calculation on this is going to be the strike price that we selected plus the premium that we paid, which means that we need NVIDIA actually not to get above 200, but we need it to get above 203. When you're buying the call option, your break-even point is not the strike. It's the strike plus the premium that you paid. So again, your risk assessment on this is 300. You're not going to lose more than that. However, you do need NVIDIA to get above 200 by expiration date. Sorry, you need NVIDIA to get above 203 before expiration date. See, even I get a little jumbled sometimes. And I just always have to remember and remind myself, it's strike plus the premium that you paid. Okay, so your payoff profile. So your loss is always going to be capped at the premium. Your upside is going to be unlimited with this call option. And theta or time decay does apply to this position. So for example, just keeping it super simple here, you buy that call option for $300 and the theta on that is 0.01. That means that tomorrow, everything held constant and equal, that option is going to be worth 2.99 because it's not the worth as much as it was yesterday because it has had a day tick by. And then direction does matter. On this, you do need NVIDIA to start rising up in price and you need it to cross above 203. So when should you use this long call? Well, you definitely have to have a bullish directional view. You have to have a sentiment on this that's like, you know what, it's been punished or it's coming down to support. And so I'm putting in a directional view on this that is very bullish. You expect to move soon. So you might be timing this with earnings. So you might say, hey, they have earnings out in a month from now or 2 months from now. And I'm going to try and get that call option that's right behind earnings. And so I'm thinking that between now and then, there's a really good chance that it's going to move spectacularly on an earnings event. Or there could be something that you think about with the news, right? So maybe there's going to be bad news or good news that could positively affect your stock. So with NVIDIA, maybe I'm thinking they're going to enter into a new contract or a new agreement with another big customer that's going to have a lot of AI chip demand for them. So you can look back on what the time of NVIDIA for the last year and you can see, hey, relatively speaking, is the volatility of the stock high or low? Just for NVIDIA, of course, that's all we're kind of looking at. And if it's low compared to what it normally trades at, maybe I want to buy that call option because if volatility is low, the likelihood of the volatility rising is higher than if the volatility is already high. And defined risks, long call even, this is always going to be your strike price plus the premium that you paid that equals your break-even point. Your requirement is that the stock must exceed the break-even point by expiration for you to profit on this. And your challenge is that you're going to see this time decay work. And it's true that many calls fail, not because the direction was wrong, but because the price didn't move far enough, fast enough, or soon enough. So there is that kind of trifecta with buying the long option of either a call or a put, that you do have to be right on the direction and on the time and the magnitude of that directional move. The risk and reward, your maximum loss is always going to be your premium that you paid, and your upside potential is unlimited. Now, I know we've already talked about this, so I'm not going to dig too far into it. However, I do want to emphasize this part, and this is what's very attractive about long calls and long puts. They do offer for you the purest form of an asymmetric bet. With this, you're looking at a trade where your loss is defined, capped, but your upside is completely unlimited. Defining attribute of an asymmetric bet where your loss is capped, but your upside is unlimited. The long put, when to use it. You have a bearish outlook on a stock, you expect the stock to decline, or you think there's going to be a risky environment looking ahead, or you're just not certain of how things are going to go. You think that you could actually profit from this, and so you buy that directional bet of a put. Long put, when to use it. So, of course, you're going to have a bearish outlook on the stock. You're thinking that it's going to go down, and so you expect the stock to decline. That's when you would buy a put. Hedge against drawdowns. So let's say, for example, you own shares. So you own NVIDIA or you own Microsoft, and so you're coming up to earnings. You want to hedge that downside risk away. So you would buy a put to hedge your shares. This is like buying an insurance policy for your investment portfolio. You expect volatility to expand. So if you're entering into a long put, you do profit if the volatility rises. So if market volatility rises, the VIX rises, that expansion of volatility will help your long put position. And you want to enter into a defined risk for your bearish bet, which is a hallmark attribute of the put for bearish traders. What I'm trying to get at here is when you buy that put, you do have that defined risk. But when you short a stock, which is also a bearish bet or a bearish trade, what happens is that when you're short a stock, you do expose yourself to unlimited upside, which could very much hurt your bearish position. And so some bearish traders will buy puts because that gives them a margin of safety, a defined risk, and they're not going to get a margin call on buying a long put. The long put break even is very similar to the long call break even. It's strike price minus the premium that you paid, and that gives you your break even. So for example, the stock must fall below your break even for you to profit. So in our example of NVIDIA trading at 195, we would buy the 190 put. But because we paid $3 of upside premium, we need the stock to drop below 7 in order for us to start making money on that. However, if we're buying it for a hedge, we're just happy that we're staying above 90, because anything under 190, we would get fully hedged and we would still own that right to sell NVIDIA stock at 190. Long put risk and reward, very much the same as it is for long calls. We have a maximum profit that is the strike minus the strike price is the total profit that we could expect to get. The put a defined maximum profit because the stock has a defined stock price at the time that we bought that long put. So if the stock goes to 0, the most we could truly expect to get paid is, say, for example, with NVIDIA here at 190, is that full drop 190 down to 0. Our maximum loss is always going to be the amount that we paid. So some subtle differences here between calls and puts, being on the long side of them, but by and large, they're essentially the same, just different directions. So calls are a bullish directional bet. They profit from upward movement and they have unlimited upside potential. Puts, on the other hand, are bearish and they're saying, yeah, the stock's going to go down, and then you profit from a downward movement, or you're able to hedge your portfolio on that downward movement. I really like the images here of the positive, optimistic, aggressive bull that we have. And on the other side, we have this bear that you just look at him and he kind of looks a little depressed. But yeah, that's how it goes. And I think over the long term, you want to be positive. You want to be bullish on the markets. Bears are just no fun to be around at parties. They sound intelligent, but on the long term, they don't do as good as bulls do when it comes to portfolio performance. Okay, let's do our quick quiz between calls and puts. So let's say you buy a call option with a 100 strike for $5 in premium. The stock rises to 110. What is your profit? Now, because you have the 100 strike, it's not going to be 110 minus 100 because you paid that $5 in premium. So in this, you take your 110 minus your strike of 100, but you do have to account for the premium that you paid. So you have to give $5. So then what you're looking at here is $500 in total profit. Next question. You buy a put option with a 50 strike for $3 in premium. The stock falls to 45. What is your break even? So I go $50 minus the $3 in premium. That gives me 47. So as the stock drops below 50, I still needed to get below 47 in order for it to be truly profitable for me. Which strategy has unlimited upside potential? That's an easy question, and that's definitely going to be the long call. All right, just a reminder, if you're interested in getting started with your options trading career, this is the best way that you can get started. Number one, go to joincfu.com/starter kit. In there, you're going to get access to a free ebook, a free scanner, and access to our Discord community. You put these three together, you're going to learn how to trade options better. You're going to put together some intelligence with that scanner. It's going to go through and it's going to find you the best put credit spread to trade on Alibaba, for example, within the next 2 weeks. The community that we have is vibrant. We crossed over 1,000 members and we are growing each and every single day. It's a great community that you can share ideas with and share trading ideas for making more money and more profit. All right, let's get into some fun things. Let's talk about intrinsic value versus time value. All right. Now, intrinsic value. All right, let's keep going. Let's get back at it. Okay, the intrinsic value of an option. So for the intrinsic value, this is the true value and this is the true value of that option. So let's go back to one of the examples we used. Let's go with the Microsoft 500. So the Microsoft 500 call, let's say Microsoft is trading at 505. The intrinsic value that I have on that option is $5 per share because I have the right to buy Microsoft at 500 and currently right now in the market it's trading at 505. So 505 minus 500, that gives me my intrinsic value of $5. Time value. This is the future potential that you have with the stock. So say, for example, with Microsoft, it's trading at 505 and you have the right to buy Microsoft at 500. I think you can understand very quickly that if I have the right to buy Microsoft between now and 2 weeks versus now and 6 months, the one between now and 6 months is inherently going to be worth more. I have more time, more opportunity for good things to happen in Microsoft and profit from any move up from there. But even if something good happens 3 months from now, the one who holds it just 2 weeks from now is going to run out of time. And so the time value comes into play. With Microsoft trading at 505, the option that expires in 2 weeks from now, that's going to be worth something like 50 or so. One that's going to expire 6 months from now, that could likely be worth about $10 to $15 per share. And when I say $10 to $15, we're talking to $1,500. That's just a quick expression of how much time value does come into play with an option. Over time, as we get closer and closer to that option that expires in 6 months, and if Microsoft continues to trade at 500, what you'll see is that premium or that value of the stock will start to decline. It'll close in on the true intrinsic value. On expiration date, it will be precisely priced at the intrinsic value. One way to look at it is every option starts with everything baked in terms of time value, intrinsic value, volatility, the hedging value, and like dividend value that's coming into play, interest rates, et cetera. It's all factored in. And today we're going to go through some of that. We're going to go through all the factors that come into pricing option correctly. But just talking about intrinsic and time value, as we get closer to the expiration date, every option will become only worth the intrinsic value at the end. That's why an out of the money option at the start, it's all just time value and volatility value. As we get closer to expiration and it never goes into the money, that option will expire worthless. Time decay is the slow melting of time and slow melting of the value that's in that option. So what is an options chain? If you've not heard about this before, you are lucky. If you have heard about it and don't understand it, you are among the normal. This is one of the most difficult things to understand when it comes to option trading. What I'm going to do to help us today is I'm going to bring across this chart. This is barchart.com, and they do happen to have a really good option chain. So let's go to Microsoft. Let's go down to the options. So they have an entire option section dedicated to option trading. So if we go to option prices, what we're going to see here is to see a long list of all of this. Now, this looks like a long serial list of calls and puts. But here's the kicker. This is just for January 30th. This is just for the weekly expiry. So if we wanted to go, I want to see them side by side. So I want to see calls and puts that are here. And then I also want to go, okay, near the money is a good one to look at. And these are all of the different options that are expiring for Microsoft. This is why having a scanner to go through and find a really good option trade for you is valuable because it eliminates so much time out of it. But let's just go forward here. Let's go to February 20th. That would be this one right here. And that's going to be the monthly option expiry, right? Because that's the third Friday in February. And you can see that here goes weekly at Feb 6, Feb 9, Feb 13. Here's your weekly that are expiring. What I do is I come up here and I just want to change the expiry date. I want to go down to February 20th. I click that, and here are all the options that are being traded for Feb 20 for Microsoft. And we're looking at calls and puts. When you go down here, what we're seeing here, these are the ones that are at the money. These two that are highlighted for us are at the money. And why is it called a chain? Well, it just kind of has that look to it. It's like a chain. Here you are for all the option strikes and all of their prices that are here for February 20th. What we see here are the latest prices that all of these calls traded for, the bid and the ask, how much it changed throughout the day. And this is really cool too. You can see how much volume traded for those options. So for example, the 470 for Microsoft call options for February 20th, they traded 1,039 contracts today. Over here, what you'll see is the open interest. And open interest is the total open contract count. So there are 4,500 470 call options that are open at this time. What's interesting though, and this is an important fact, is this number of 4,500 does not take into account the current day volume. What this indicates is that the night before there were 4,500 that were open, and then 1,039 traded throughout the day. We don't know if that's a net add or a net subtract because there could have been 4,500 that were closed out, or there could have been 1,000 that were added. We won't know that until tonight when they update the number. Okay, and so where that becomes really important is when you have, I'm just trying to find an example here where the volume exceeds the open interest. And that didn't happen today. But that's an indicator too of something going on, is if all of a sudden the volume exceeds open interest, that can indicate that somebody's making a large bet and is making a move. Okay, let's come back here to what is an option chain. So we've gone through that and we're going to move along. How do you do that again on bar chart? So what I need to show you is how you do it with the Greeks. So we go under here under volatility in Greeks, and we are interested in the February 20th, and here it is already selected for us. And let's go side by side so we can see calls and puts side by side. And what we've done here is we've selected it that we're not very interested in the current bid and ask. We're more interested in the Greeks that are for these different strikes. Why is this important? If you're interested in beginning to trade covered calls, I want you to listen really carefully here. If you're going to trade covered calls and you don't know which strike to trade, I recommend you start with selling Delta 25 or up to Delta 30, no higher than Delta 30. As you get closer and the Delta starts to rise, that does increase your risk of having your shares called away. So if I was looking at Microsoft here, where I would like to start trading is this one right here, and that's the 500 for Microsoft. The 500 strike price for February 20th, Delta 25 is right here. And that was last traded for $605 or $605 per share. That's a great trade. I would definitely be interested in that. If I wanted to go up a little more, I would indicate here that I do not want to go below 490. If once I go below 490, now I'm starting to take on more risk. When you get close to at the money, That makes delta very close to 50. And so you can see here, Microsoft is trading at 470.28, and we have the 470 is trading at delta 52, and the 472.50 is trading at delta 50. If we go over to the other side here and we look at delta on the puts, they are the exact same. Now you're likely noticing that delta is negative, and we'll get into that in a little bit when we cover delta. But delta for puts is expressed always with a negative number, and delta for calls is always expressed with a positive number. Okay, I'm just going to move that over and let's continue. The strike price explained. Okay, so one important thing when you're selecting your strike price, like we were just looking at there with Microsoft at 500, we're not going to sell that covered call. That price is fixed. So the strike price is fixed, and you get to choose it when you are the buyer or the seller of that option. You go to the market and you say, hey, I'm interested in selling the 500 for Microsoft. That's what I want to have. The strike determines if you're going to be in the money, at the money, or out of the money at the time that you execute the trade. In the future, we don't know if it's going to be in the money, at the money, or out of the money. But these are very important acronyms. ITM is in the money, ATM is at the money, OTM is out of the money. This does control your leverage and probability. As you go more out of the money to begin with, it does mean you have less of a probability of being in the money at expiration. That's why they do cost a lot less as you go more and more out of the money. The bid is the highest price a buyer is willing to pay for your stock option, and the asking price is the lowest price a seller is currently willing to accept. Here's a top tip that you always want to remember. Do not do option trades at the market. Always use limit orders. Why is that? If you go between the bid price and the ask price, you can actually get more for your money, or you're able to sell for a better price. This makes a huge difference because you're now being able to get just another dime or another nickel for your stock option. Very few times should you ever enter into or out of an option trade using market orders. In fact, I don't remember the last time that I used a market order to exit or enter into a stock option trade. I have done it before, but it was mainly in a desperation or act of urgency. It maybe was down to the last minute or two of the market closing, and I needed to get that trade completed. Otherwise, always use limit orders. It's your best bet, and I don't think you'll ever regret using limit orders. You'll find you get an extra 5 or an extra 10 on your option trade. Okay, volume. This is very important because there are so many contracts and so many expiration dates to be trading. Volume does become very important. What you want to be doing when you're starting off trading options is first, you want to be trading stocks that are very liquid and have a very active option chain. So that's going to be stocks like your Mag 7 and others that are very popular for people to be trading. What you don't want to do is trading some random rare stock that nobody's even heard about or even thought about. And when you do that, you're not going to get very good fill prices. You're going to be overpaying. If you're buying, you're going to be underselling if you're the option seller. So we want you in high volume, high liquid stocks. This also makes it so you get very easy fills. You don't have to wait very long, and the market maker will be able to fulfill your order and get you in or get you out of your trade. So always be looking at volume, open interest. Those are two very good indicators to make sure you're trading good, flexible, liquid stocks. If you have any questions on that, go and do an AI search or a Google search and say, hey, what are the top 10? What are the top 20 liquid stocks for trading stock options? You're going to find stuff like Tesla, Apple, Nvidia, AMD, Netflix, the list goes on, but it's always going to be those top names. This is the ones that everyone's interested in, and they oftentimes come with really good premiums to them too, such as high beta stocks. So you got like Strategy, etc. will be in there. Open interest tells you how much contracts are out and open at this given time. And when you have a high open interest, that's very attractive to be trading that stock option because it's going to be liquid. You're going to be able to enter into and also exit that stock option trade very easily. You're going to have tighter bid and asks on this because the market maker is able to make liquidity and fluidity come together much more easily. It also tells you what are the most interesting strikes to be trading. So, for example, when you're looking at that Microsoft for February 20th, the 500 call option, that's very liquid. That's going to be very popular. People are going to be using that a lot, especially when it comes down to expiration date. This indicates where traders have conviction. This is what they're trading. They're not going to be trading the Microsoft 200 for February 20. The trade's done. What we're interested in is 500 is going to go above or below, or 490 is going to go above or below 490. And if it's going to go above, how much? Is it 492 or 494? We don't care if we're down to 200. Like, are you seriously carrying like the 200 call option on Microsoft? Open interest tells you which ones, where the trader's putting their money. Implied volatility, this is always expressed as a percentage, and it's the market's expected movement. It's a bit of a nuance. It's not so scientific, but it does show you, generally speaking, from the market's point of view, where are we thinking this is going to go? How volatile is Procter & Gamble? Those are two extreme examples at either end of the spectrum. And so the volatility will get priced into the options. A high volatility stock or a high beta stock, such as Caesars, such as Hood, they're going to command a higher price for their option. When we express implied volatility, that's a percentage of how much volatility we are expected to have within that stock as it trades going forward. It'll spike and it'll rise when there's an event that's around the corner, such as earning, Fed decisions, elections, time of year that's just more volatile. So they'll command an additional price. If you're an option seller and you're willing to take on this risk, here's a pro tip. Often the time when you want to be selling, there's times when it's just so lucrative to sell an option. So say, for example, Tesla, as it approaches 500, if there's an event that's coming close and it's closing in on 500, a lot of people are going to be lining up to buy that 500 call option for Tesla. Great time for you to sell that call option because they're going to pay you more. They're going to pay you more for that right to buy Tesla 500 as it nears it and there's an event that's happening. Good time to sell that call option. In the money, at the money, out of the money. So ITM is in the money. This means that the stock is trading above your call option strike price, or the stock is trading below your put option strike price. At the money, just like it implies, it means it's trading right around the strike price that you're interested in. And out of the money, if you're an option seller, this is your playground. You want to be selling more out of the money than you are selling in the money. Maybe you do want to get into those out of the money options and you want to buy them. It's high risk, high reward. And there's a reason why those out of the money options are priced the way they are. Okay, let's do a quick quiz here. The stock is trading at 100. You're looking at a 95 call option with a bid of 650 and the ask is 670. Is this option in the money? And what should you pay for it? Man, that was a horrible trade. You should not have done that. The bid on this stock option is 650 and the asking price is 670. If you went into this with a market order and you're looking to buy, you're going to pay 670. But if you're smart and you go in with a limit order, you could probably buy this for 660. If you can't buy it for 660, you're going to be able to buy it for 662, 663, something like that. Use limit orders, save yourself an extra nickel or an extra dime. You can get that back when you exit the trade. Okay, keep that in mind. You own a call option with a delta 65. If the stock moves up by one, approximately how much will your option premium increase? Okay, this is a bit of a trick question because we have not covered delta yet. We will cover it later in the course, but let's just give you a little bit of a tease. Delta gives you the expression of how much an option price is going to go up in value or down in value if the stock below it or underneath it moves by $1. So if I have the 490 call option on Microsoft, and like we've always been saying, Microsoft is trading at 495, that could have a delta 65. So if Microsoft goes from 695 to 496, my call option at 490 is going to go up by 65 cents. So delta is an expression of how quickly the stock option will move for every dollar that the underlying stock moves. Now, if you don't understand that, it's totally fine. We will get into delta in more detail shortly. Your option has a theta value of -0.05. What does that mean and who benefits from this? Again, we're going to get talking about theta and delta very shortly in the course, but theta, if you're the option seller, you love a negative number. That means your price that you sold that option at is going down every day. What that value of 05 means, we'll get to that in a bit. All right, let's take a pause here and give a nod to our sponsor, CFU or Cashflow University. Thank you for making this video possible. If you're interested in starting an option trading career, if you're interested in using your retirement and using stock option trading as a way to supplement your income, this is a great opportunity for you. You can start for free. You can go to joincfu.com/starter kit, and starter kit has a hyphen in between starter and kit. The blueprint is an ebook that we share with everyone. It's 30 pages long, so it's pretty short, but it does give you all of the fundamentals and basics that are included with having to trade stock options. The intelligence is a PCS 100 scanner. This gives you the top option trades for the 30 best stock options to be trading at the given time. And that scans all day long, every minute of the day, and finds the best option trade for you. It is just the bullish side of it. We do reserve the bearish side for our paid community. The community that we're talking about is CFU, and that is a Discord community with over 1,000 active traders. In there, we share trading ideas and what we're doing, what the trades we're entering into, and getting real support from our community and our staff. So if this interests you, go to joincfu.com/starter-kit and download our ebook, grab our scanner, and join our Discord. All for free. All right, let's look at a live chain example. We did look at that on that website there, but what this gives us an opportunity is just kind of dive in more focused and see what we got here. Our stock is trading at 150. Can you think of a stock that's trading at 150? Sad to say, my immediate thought goes to strategy. Michael Saylor, why are we not trading much higher than the 160s and the 155s? Brother, let's get this above and let's get this going. I do personally hold the strategy as a shareholder. Not my favorite investment at this time, but I do believe long term it'll do well. I am a bit of a Bitcoin maxi, and I believe it is a great way to preserve your wealth and your time over time. Okay, so strategy is trading at around 150. The strike of 145, that's going to be in the money. Of course, we're talking call options here. It's very obvious. The 150 is going to be at the money, and the 155 is out of the money because it's above the 150. Okay, so the premium that we would be expected to pay for a 145 while the stock is trading at 150 would likely be something like 850. And at the money would be something more like 420. And as you can see there, we have, because we're trading at 150 and we're paying 420 because it's at the money precisely, we are paying 420 straight. The 155 out of the money is priced at 180. It goes down significantly in price because as we get higher and higher out of the money, the value of that's going to go down as it gets less likely that it's going to end up being profitable for the holder of that option. Common chain mistakes, ignoring liquidity. You should pay attention to liquidity. That's both volume and open interest. Chasing cheap out of the money options is a sure way to run through your account very quickly. You won't get margin call, but if you keep on doing those out of the money trades, you're going to run out of money. Buying high IV all the time. There's a reason why they're charging you so much on that implied volatility. I would much rather be on the selling side of that, especially when I can buy a lower put option to hedge away my risk. So this is also why we like to track all of the trades that we have at CFU, because tracking our entry prices, tracking the strikes that we're getting into, that helps us to always keep in mind what our break-even price is and what we have to do to make that trade profitable for us. This is why these are some very common chain mistakes and a good thing to keep in mind as you start trading options. Okay, we're approaching likely one of the most difficult parts of the guide and the presentation. We're going to start diving into why Greeks matter. You've often heard that options have Greeks. If you haven't heard about that before, they measure the sensitivity as why an option is priced the way that it is, and they can give you some prediction on the behavior as it goes forward with time. Let's dive in, and what I'm going to do, and this is key, I'm going to tell you which Greeks matter the most. Now, there are 4 that we're going to talk about today. We're going to talk about delta, we're going to talk about theta, we're going to talk about gamma, we're going to talk about Vega. Let's talk about those 4. Delta is the most important that we're going to talk about today because it fills many roles. The second one that's very important is theta. Next, it's gamma. While important, we can put it off on hold for now if you don't need to know any more about it. And lastly is Vega. Vega, the number isn't as important as it is just the direction and the sensitivity. So let's get into delta and the rest, and I'll give you a really good explanation on each one and highlight which ones matter the most. Delta. This is the one you want to know. If you're going to start studying Greeks, start with delta. The number of delta tells you for every dollar that the underlying stock moves, how much is the price of the option going to move. This is always factored between 0 and 1. I guess you could go -1 to 0 if you're on the other side with the put. But by and large, the value is between 0 and 1. When it's 1, one of the weirdest things with delta 2 is that it's a proxy for probability. You'll hear guys say, I traded the delta 65, I have a 65% chance of being profitable. Let's dive into that a little further. The technical definition of delta is just for every dollar that the underlying moves, how much is the stock option going to go up or down in value? They've just kind of noticed that over time, it is a very good proxy for the probability. So if you dive into an option and you take all the other factors into account and you say, what's the probability of this option ending up in the money? If you're trading the delta 65, you run the calculations, you'll be looking at, well, it's like 64% chance it's going to be in the money, or it's going to be 67% chance it's going to be in the money. So it's a very close proximity to the actual factor if you factor it all in. So everyone just goes with it and says, you know what, delta 65% chance of being in the money. Now, this is where I want you to focus. It is not the probability that you will be profitable. It is the probability that it will end in the money. And that makes a big difference. It makes a huge difference. If you buy delta 65 and you pay $4.50, it is not a 65% chance that it's going to be higher than 4.50 at expiration. It's just saying that at expiration, that option will be worth more than 0. And that's all the probability is saying. So if you buy that delta 65 for 4.50 and it ends in the money and it has $1 of intrinsic value, that's an expression of that 65% coming true. The probability of profit is much different. That is a different calculation, and delta cannot be used for probability of profit. Delta in practice. So at the money, we already talked about this, so it's kind of nice to come back to it and get it reinforced. So at the money options, delta 50, that's a good definition there. If you're trading delta 35, delta 25, that's a rough estimate right out of the gate that you're trading out of the money. And as you get closer to delta 1.0, that is very close to being exercised. And so as you get closer to delta 99, delta 98, you're getting really close to, there's just not much left in this option. And it's time for this to go to intrinsic value. Out of the money options, we'll have a lower delta and they'll get very close to 0. So delta 1, delta 5. Yeah, there's a 5% chance that's going to be in the money, or there's a 1% chance that's going to be in the money. Delta dynamics. So this is something to keep in mind too, and we'll touch on this when we get to gamma, but delta changes as the stock moves. So as the stock gets closer to your strike price, the delta will start to accelerate, and gamma is the expression of that acceleration. So when we get to gamma, you'll want to think back on this, but yeah, gamma is the accelerator, and it's the acceleration of delta. It increases as you get closer into the money, and as you get further out of the money, the acceleration will start to slow down. Okay, so let's get into an example with delta. You have a starting position that you want to own a call with delta 60. The stock moves by $1, and your option gain will approximately be 60. Reality check, delta is an estimate. It's never a guarantee, but it is a very good estimate, and it'll come in somewhere around there. Theta. Now, if delta is the most important, theta is next. Theta tells you that the time decay for this option. If you're an option seller, you love negative time decay. You love negative theta. It tells you for every day that goes by, everything else held constant, theta hurts the buyers, theta helps the sellers. So if you're a seller, you love theta. If you're the buyer, you secretly don't like it. In fact, it may not be a secret. You hate it. It accelerates near the expiration. So if you're selling an option 6 months out, 3 months out, or 2 weeks out, Theta is different. It accelerates the closer you get to that option expiry date. It happens every single day. Now, this is an important part too, and keep this in mind. Theta also goes over the weekend. So if you go 3 days in a row, a long weekend, or Saturday, Sunday, Theta cuts in every single day. Gamma. Gamma is important. This is how you want to play with gamma. Gamma tells you the delta change rate. It tells you how quickly delta will accelerate or delta will decelerate for every dollar that it moves on. It tells you how much delta will change as we go up or down in price for the stock. The further you are out from the expiration date, gamma won't be accelerating that quickly because there's so much time into the future, anything could happen. But as we get closer to the expiration date, gamma will increase because for every dollar that the stock moves, the option price is going to jump much more because the intrinsic value is getting defined. And we're finding out the real value of all of these options as we approach expiry. The second point is it explodes near expiration. It'll really accelerate. And it's higher when you're near the money, and it creates rapid profit and loss swings. And this is the second part about gamma. That it's just more the concept. As you get closer to having your profitable option trade, not much will be left in that trade. It's becoming very clear what the intrinsic value of that option is. The only thing that's left is tail risk. And when I say tail risk, think of that bell curve. And there's tail risk on one side and there's tail risk on the other side. That's gamma. That's your expression of what my risk is. Keep in mind, is gamma is your tail risk. If you don't remember anything else about gamma, remember that. What's the risk of that gray swan event? What's the risk of that black swan event? Gamma is your expression of that. And as you get closer to expiry, as you get closer to being fully profitable on a trade, the only thing left is gamma. And it's the one that bites you. It's like that snake in the woods. It just comes out and gets you. You don't want to be exposed to gamma risk more than what's necessary. So as gamma rises, it's a good indicator that it's probably time to close out the trade and move on. If you're doing defined risk trades, such as put credit spreads or call credit spreads, when they have a defined risk and a defined profit, as you get closer to 80% profit, that's a really good opportunity for you to get out because that last 20% is almost entirely gamma risk. And you're going to be waiting days for that last dime or that last nickel to come to. And all you're being exposed to each and every day is a Trump tweet that could come out and ruin your position, or a new policy change, or some random piece of news that your stock issues, and now you're done. So don't expose yourself to gamma risk more than what's necessary. So that's what you need to understand. Next is Vega. Vega tells you for every percentage increase of implied volatility, how much will my option change? So as volatility increases and you have a Vega positive or a Vega sensitive exposure, it tells you how much will my option go up in value. So say I have just volatility or the IV for a particular stock is 56% and it rises up to 57%, it means that the option buyers are willing to pay a little bit more because there's some inherent implied volatility with the trade because nothing else has changed. But why are they all of a sudden starting to pay more? It's because implied volatility is starting to rise. Your Vega number is going to be like 0.1 or 0.05. That's going to tell you for every point increase in percentage, how much is your option price going to go up. So if we just went from 56 to 58 and we have a Vega, that means because we went up by 2 percentage points, now we're going to have 20 cents added on to the option price. Why this is important, and I guess you don't really need to know the numbers on this, but the concept is very important. You have a Vega positive trade. If volatility increases or if it expands, you're going to make more money. However, if that volatility collapses and goes down, you're going to have what's called volatility crush or IV crush. This happens a lot around binary events, such as Fed rate decisions or earning events. That can increase, explode your volatility, or collapse your volatility. And you'll see option prices after earnings events will collapse. And that's because you were Vega positive when you entered into the trade and you're wondering, what the heck happened? I paid a good sum for that option. And now the next day, I'm down quite a bit, even though I'm still in the money. It's because the volatility got sucked out of the option and it's down quite a bit. Vega in practice. I guess we just kind of went over this. It's before earnings, it's before an earnings release or something that is anticipated to be in the future. It's going to change your value of the option. So let's bring it all and wrap it. This is a very important part of the entire guide and the presentation. Greeks together: delta, theta, gamma, vega. And I did list them in the most important down to the least important that you need to remember. If you don't learn any other Greeks, or if you're wondering which Greek do I start with, it's delta. No question, delta. Learn what it is, and it can help you decide which strike to sell as a cash secured put. It can tell you how much you should buy when you're going long on a call option. It's very important. On top of that, it also tells you the probability that an option will expire in the money. Next is theta. It tells you how much this thing is going to go down in value, all things held constant. It indicates to you if you're trading good into the money or out of the money. And it also tells you if you should roll an option spread. So a lot of the trading that we do are put credit spreads, put debit spreads, call credit spreads, call debit spreads. When theta flips and it goes negative on you, you want to get out of that trade because you're starting to pay the theta as an option trader if you're the option seller. Gamma is going to tell you how quickly options are accelerating. And then Vega tells you the implied volatility sensitivity that you have with your option trade. So again, those are the most important parts about Greeks. When you wrap them all together, it gives you a really good indicator of how much that price of the stock is being priced and affected by the Greeks: delta, theta, gamma, vega. Again, there is the other one called rho, and that does tell you interest rate sensitivity. It's very minor, especially when interest rates aren't really changing much over these days, even when they're changing 1 or 2 rate cuts a year. But we don't need to get too far into it. But it does tell you if an interest rate goes up or down, how much it's going to impact the price of the stock. Greeks quiz. Fun, right? As soon as you think you haven't had enough fun with options on the Greeks, now we get a Greeks quiz. Here we go. So you buy a call option with delta 70, theta negative 0.8, and gamma 0.5. The stock rises $2 overnight. Ignoring time decay, how much did your option gain? It gained at least $1.40 because delta is 70 and I have a $2 appreciation overnight. So that means I'm talking about $1.40. Now, if you want to get a little more nuanced in it, it is telling us that for every dollar that the stock goes up, gamma is 0.5. So as it goes from $0 to $1, which is enough for gamma to kick in, that's going to make delta increase to, so delta goes from delta 70 to delta 75 on the second dollar. So a very more accurate estimate would be that tomorrow it's going to be $1.45. And that's gamma kicking in to accelerate delta. Your option has theta negative 10 over a 3-day weekend when the market is closed. How much value does your option lose over that weekend? The answer is 30 cents. You're holding options before an earnings announcement. IV is at 60% and your option Vega is 0.15. After earnings, IV drops to 40. What happens to your option value? Okay, your option is going to lose $3 per share. I don't even have to know what the value of your option is heading into this. If Vega is 15 and you just dropped from 60 down to 40, that's 20 basis points of implied volatility being sucked out of your option trade. And because we're using Vega 1.5, we get to multiply that by the 20 points. So therefore that comes out to $3 per share or $300 for your contract. That's how quickly implied volatility can impact you. It includes an ebook, a scanner, and access to their Discord. With that access to their Discord, you get 1 to 2 free trades a month and an opportunity to see how CFU works and operates, get accustomed to the community, and in the future, you can join as a paid member and get all of much more. You get access to our 6 pro traders and access to more scanners and more value. The strategy spectrum. Okay. Just got to show you my macro hard shirt. See how awesome that is? And to go with my macro hard shirt, I do have the CFU hat on. They're our sponsor for tonight. Oh man, I can't. Yeah, they're our sponsor for tonight's episode. So head on over to joincfu.com. Those guys are great. I know the guy who founded it. It's me. But anyways, macro hard. I love it. It's a play on Microsoft. Okay, strategy spectrum. Now that we've covered all the basics so far, let's get into some of the trades you're going to be executing as a learner and as a beginner for trading options. Number one, we're going to have income strategies. These are the most attractive, and that's mostly how people get into option trading. They start with covered calls, cash secured puts, credit spreads. There are all low stress, consistent gains that you can expect with defined risk. They are the best for patient traders. They are a great way for you to fleece and generate some income off of your stock positions that you already own. Speculation strategies. These involve long calls and long puts. I'll put an asterisk beside long puts because you could be using those to be hedging. You have debit spreads and they are a little more high intense and leverage focused, and you do rely more on directional bets. They do require more precision in your trading. So hearing that, you might be more of an income trader, you might be more of a speculator trader, or you might be somewhere in between. I myself, I'm a little bit more income with some speculation. I'm probably 80% income, 20% spec. I do generally like to just sell some options, generate some income, take that income, buy more stock. But I also do like that G-Gen, like I have a long call on Novo Nordisk, or I have a long call out on, what was the one we did lately? We did Dow Chemical, done. We currently have one on Intel, which is going, well, it could be going better if you wanted to hear the honest answer on that one. But yeah, so they're speculative bets. They could go to your favor or they could end up being absolute disasters. But the best part about the speculation strategies is most of the time they're using defined risk elements to them. So with a long call or a long put, you know what your risk is going in. All right, let's get into some of the income strategies. You're probably going to start with a covered call. So you have 100 shares of your favorite company and you own that ownership. You're a participant or a shareholder within the investment of that company, and you just want to sell some income and generate that and pocket that and put that in your jeans. If you do a covered call, that's a great way to get started. Sell out of the money. You want to sell Delta 25 to Delta 35. You want to collect that income and it will be deposited into your brokerage account immediately. You got it. It's yours. You get to keep it regardless of the outcome. In exchange for this income, you are capping your upside. So that buyer of the option, remember, he has the right, but not the obligation to buy your shares from you at a set price in the future. For that right, he gives you some money up front. Covered call pros and cons. The advantage is you get a steady income in flat markets. It does reduce your cost basis and it's lower risk than naked stock ownership. It works with dividend strategies as well. So you can combine the two. So you can take out a position in Procter & Gamble, Johnson & Johnson, ExxonMobil. You pick your dividend stock, and then you can also sell covered calls on it. Or you can also sell cash secured puts, which we'll get to in a second here. The disadvantage is that you have limited upside if the stock does race away on you. Another disadvantage is that you're still exposed to your downside risk. And you do have to have 100 share lots. For a smaller investor or someone who's just starting, this can be a big barrier to entry. Say, for example, we're going to trade covered calls on Tesla, which is trading around the 440 mark at the time of this recording. You're going to need $44,000 to own 100 shares of Tesla in order to start playing that game with covered calls. The cash secured put is another favorite of many investors. You have a cash set aside within your brokerage account and you have the ability to buy 100 shares, but you think, yeah, maybe I don't want to pay the market price at this time. Instead, I want to get it in at a lower price. And so you sell the put option in order to get in at a set price that would be lower than the prevailing market price at this time. For that, you do collect premium. A buyer of that put option who wants to hedge their position will actually pay you for this. You'll collect that premium. And again, that comes in your brokerage account and you get to keep it. No matter what happens, you get to keep that money. You do have potential assignment. So if that stock does fall below your strike price, you will have to buy those shares at that price. One way to look at cash secured puts is that you're getting paid to be patient. CSP's pros and cons. So CSP, that's the cash secured put. That's the acronym for it. You get income while you wait to buy. It's an effective discount on entry if you do get assigned those shares. You do have a defined maximum risk on this, which is the stock price in its entirety, and it does work in sideways markets. The disadvantage is you're obliged to pay and buy that stock if it does get assigned to you. Now, I know going in, you might be looking at Microsoft is at 495 or Tesla's at 440. And you might say to yourself, you know what? I'd be willing to buy Tesla at 400 if it ever had the chance. Well, when it comes down to it, sometimes it does happen. And you've got this 400 CSP out on Tesla, and now Tesla's down at 325. Yikes. You could have bought it at 325, but instead you're buying it at 400, and that can hurt sometimes. So you are exposed to the full downside risk. And if it does rally, like say you did have that 400 Tesla cash secured put, Tesla could go up to 500 and you missed out on all that upside because you got paid $500 to hold that insurance. And it goes for covered calls too. You can feel like you're the one holding the bag while the party's going on. And sometimes that can be a disadvantage and can make you feel like, ah, man, like I wish I could have gotten in on some of that the price appreciation from 400 to, or so from 440 to up to 500. Should have just bought the stock. Long calls and puts, these are your directional speculation bets. I love this image of the lightning splitting into, it's going to go one way or the other. With that, you do get some leverage. So you are controlling 100 shares of the stock and you're not having to pay anywhere near what that 100 shares would be worth. You do have defined loss. So that's a very attractive point. So if you're buying that bearish put, you might be very attracted to the defined loss mechanism within that, hey, I can benefit on this bearish trade. And the most I can lose is the premium that I pay out front, which is sometimes much more attractive than just a straight short sale. The downside of long calls and puts is they have a very high failure rate. So just the way it goes, for some reason, they just tend to fail when you're buying out of the money, especially. So just keep that in mind. And you do want to, that's one of the things you could take advantage of is if you're doing covered calls or cash secured puts, the odds are in your favor. You are being the casino in this relationship. The protective put, this is going long on that put. You own the stock, you buy the put, and you're setting a floor for your downside risk. This can be especially useful when you're going into earnings or a Fed rate decision. You want to know what your downside risk is, and you capped it. Now, the downside of all this is that you do have to pay for this. No one's going to allow you to hedge your stock for free. And the protective put is going to cost you some money. You're paying for insurance effectively. The wheel strategy. This is a very time-tested favorite amongst most option traders. It's taking the cash secured put and combining it with the covered call. Now, this is very effective if you do have enough cash to be assigned the shares and you do have enough cash to hold and actually sell covered calls on it. How it works is you enter in, usually you sell a cash secured put to begin with. You keep on selling cash secured puts until you do get assigned. You get assigned the stock, and then you start to immediately sell covered calls on it. Once the call is called away and you sell those shares, you just repeat again. You go into the cash secured put once again. This is a very effective strategy if all you want is income out of the stock and you are willing to be assigned and you are willing to be exercised against. You just keep on selling cash secured puts and covers, keep on wheeling. As you go through this cycle, you make a lot of money in income. Let's go into position sizing. This is a very important part of option trading. If you're just starting off, I want you just trading one contract. Again, not financial advice, of course, but if you're trading options and you're just starting, start with the bare minimum of the lowest risk that you have. So if you do something weird or you fat finger the trade, the most you're going to lose is an acceptable amount. And you're not going to lose sleep at night. Start with one contract. Number two, if you do have more than that, risk only 1% to 2% per trade. If you're risking more than that, you better know what you're doing. This will prevent blowups. They do happen, and they sadly do occur most often with option traders who get in over their head and don't know exactly what they're doing, and they're exposed to risks that they did not consider. If you take this into account, do no more than 1 to 2 trade, and you're not going to blow up your account, you're not going to revenge trade, you're not going to get over your head, then you'll have longevity. And most of the time with option trading and mostly with investing, time in the market is more important than timing the market. Stop loss discipline. You do want to have, with every trade that you get into, you do want to have a defined exit. And perhaps with options more than with stock, this is easier to do because you do have a defined period of time because you have an expiry date that you do have to take some action eventually. If you're starting to lose, perhaps it's time to cut that loss and reassess. Is this still the same stock? Has the fundamentals changed? Why was I wrong? and then reassess and take the next step that's in your interest from there. Common beginner mistakes. So, number one, we just talked about this too, oversizing your positions. Don't take on too much risk. As a founder and as a trader myself within CFU, I do see this time every once in a while with people oversizing their positions. Don't do this. Start small. Most of the problems that we encounter with members as they're trading and as they're getting in over their head is they took on too much risk. They oversized, they started trading more contracts than they should have been. They ignore theta. They think that this long call is going to last forever and I don't need to take into account or reassess it a month from now or 2 months from now. You should not ignore theta. Chasing cheap options. This gets back to that YOLO mentality or that degen mentality. Don't chase cheap options, the ones that are $10 or $20. There's a reason why they're priced like that. And there's a reason why some Tesla shareholder is willing to sell you that call option for $10 or $20. It's because there's no way it's going to happen. And so that's why they do it. They sell that to you and they just say, hey, well, 10 bucks is 10 bucks in my pocket. And you get to sit there and watch it go to zero. FOMO trades, by the time you feel it and by the time you know it, the trade's over. So right now, one of the FOMO things that was happening is silver is at around $100 and people are jumping in or jumping out or shorting in or jumping in. It's silver. It hasn't changed. Sure, there could be something going on with supply, but these are all narratives and stories. FOMO trading is never a strategy. You're letting emotion govern and dictate and decide for you. And as a trader, I never want to be in that position where I'm feeling an emotion and I'm feeling that I need to do something based on the actions of others. Forget that is not a good disciplined strategy for trading. Paper trading first. Okay, so yes, I do recommend you start with paper trading. It's a good idea to do. Don't spend too much time with it because it can only take you so far. Paper trading, especially for options, is usually one of the last features that a brokerage will introduce and put into their software. There's not many people that do paper trading, and it's kind of the last thing. And then options is even less. People who are going to trade options usually just jump in. But it is a good opportunity for you to kind of get used to how do I enter in this order? What are my limits that I'm putting in? Am I doing a debit or a credit? What are the strikes that I'm working with? You'll get fill orders that would just never happen. And so take it with a grain of salt, use paper trading to your advantage. Just know that the value that you're getting out of that learning scenario is very limited and it's time to start trading with real money. Now, caveat with that is when you start trading with real money, start low, start slow and let it come to you and get ready and get used to what it feels like to trade options. And then once you're used to it, you've got your method down pat, then you can start to scale and trade more option contracts. The trading psychology, discipline beats intelligence. The disciplined trader will often outperform the genius, intelligent trader. They're overthinking things. Discipline will beat intelligence. Emotion distorts your decision. Do not trade with emotion. Trade with a sober mind that is able to carefully, slowly, and consciously calculate and know what you're doing. If you're rushing things, if you're making decisions based on FOMO, or you feel this strange emotion of fear or excitement, those are usually indicators that your emotions are governing your decisions. You do not want to trade with emotion. You want the fact and the number to be the prevailing decision maker with your decisions for trading options. Consistency matters. Being consistent in your method and how you approach trading options will be a larger indicator of everything than just being 1 month in and 1 month out. Know why you're trading. Are you being consistent with your approach? Are you doing consistent charting? Are you consistently selling your call options that you're doing for covered calls into strength and making sure that you always have this indicator as to why you are doing a particular trade? Consistency matters. And when you're tracking your trades, you can come back to it and you can say, hey, this is an opportunity for me to refine my consistency. Well, it's time to get closing up on the presentation here. So we started off by talking about the 2026 market reality. We have higher volatility than ever. And I do think that through the year of 2026, we will continue to have heightened volatility. The political landscape is as divisive as it ever has been. And we have more than enough reasons with the midterm elections this year for it to be even more volatile. Markets are faster. With the age of AI, we're trading against robots, faster markets, zero data expiry options, and stocks such as Nvidia, Microsoft, Apple now have expiries on Monday, Wednesday, and Friday. It's getting insane. And the volume of contracts being traded every day is 59 million. And that is only going to increase as we go forward. The market reality is if you're going to trade options, you need to know what you're doing. And the reality of 2026 is also there's more community and there's more opportunity to share your knowledge with others, sharing knowledge with you so you can be a better trader. This is an amazing time that we live in. This wasn't around when I was starting to trade options. I had to read a book and I went on the market and the spreads were horrible and the commissions were high. We live in a very fast, liquid environment right now, and it's the best time to be trading stock options. Income versus speculation, know which way you're going to go. If you don't know which way to go, start with income if you can afford it. If you can't afford it, start with speculation, of course, but just be very measured in how you do that. If you're a small account and you're starting to save and you're starting to invest, likelihood is your best path forward is just to save cash and buy an index fund. Once you start to have enough money, start on the income approach and start with covered calls. It's the easiest one to understand. Then jump into a cash secured put and then build into the wheel and see how covered calls and cash secured puts can be a strategy that works very well. And as you get better and better at trading options, you'll look for other opportunities. The good thing is with CFU, we're here with you all the way through your experience in your career of trading options. We see people start and they have no idea what they're doing. Within 3 months, they're trading very well. And then after a year, they're doing extremely well. And everything's become second nature to them. One of our clients that we've been working with for just over 2 years, in just 2 years, he got 136 total return on his portfolio. And now, if you're thinking this guy only had a $5,000 account, you're incorrect. He started with over 100,000, and we have him up closing in on 300,000 now. And that's fantastic. That's because he was very disciplined and knew what he was doing. Beginner checklist, learn your basics, paper trade for a little bit, but don't paper trade forever. Start small, one contract. And then when you know what you're doing, okay, now we can start talking about 2 contracts. Journal everything, record everything. Very important. Lastly, we're going to end this with our last shout out with our sponsor, CFU. If you're interested in becoming a better option trader, if you're interested in starting your journey as an option trader, go to joincfu.com/starter-kit and get your free copy of our ebook, access to our trade scanner, and access to our Discord where you can share ideas and learn from others. And then when you're ready to take the jump, become a full member of CFU and open up all the doors and all the access. Get access to our 6 pro traders and get access to our bearish scanners, our bullish scanners. So go to joincfu.com/starter-kit and grab your starter kit and get started today. I'm looking forward to trading with you. I'm looking forward to get to know you and hearing your story and hearing about your success. I'm Steven. Thanks for being with me today, and we'll talk to you soon.